let's talk about a market that quietly, behind the scenes, influences pretty much everything in your financial life. Seriously, we're talking your mortgage, your job, your retirement savings, the whole deal. It's this hidden giant, and today, we're going to pull back the curtain. I mean, just think about this for a second. What if there was one single market worth over $100 trillion that was the invisible hand guiding the entire global economy? A market that most people never, ever think about, but its every little move can literally make or break fortunes. And nope, before you even say it, it is not the stock market, not crypto, not real estate. It's something much, much bigger and way more fundamental. It's the bond market, and it is, without a doubt, the most important piece of the global financial system. It's the absolute bedrock that everything else is built on. So what on earth is a bond? Let's start with the basics, right? We're going to break down this simple IOU that literally powers entire countries. At its very core, a bond is just a loan. It's that simple. Imagine you need cash to start a business. You go out, you borrow money, and you write an IOU, promising to pay it back plus a little extra for their trouble, right? That's interest. Well, governments do the exact same thing, just on a mind-boggling scale. When a government needs money, it issues a bond, and an investor, that could be a huge bank, your pension fund, or even you, acts as the lender. So you might be wondering, where do governments get their money anyway? Well, for most countries, like the UK you see here, the vast, vast majority of it comes from taxes. That's the money that's supposed to pay for all the public services we rely on: healthcare, roads, defense, you name it. But here's the catch. Governments almost always spend more money than they actually bring in through taxes. This gap, this shortfall between what they spend and what they collect, that's called the budget deficit. And they have to fill that hole somehow. And every single year that a government runs a deficit, that amount just gets added to its total national debt. To give you some perspective, the UK's national debt is currently sitting at a staggering £2.7 trillion. Just let that number sink in. And believe me, this isn't just a UK problem, it is a global thing. Over in the United States, the national debt has blown past $36 trillion. So how do they cover these insane shortfalls? They borrow. They borrow it all by issuing those government bonds we were just talking about. Okay, so this brings us to the real mechanics of the market itself. How are the prices for these giant IOUs actually decided? Let's get into the key terms you absolutely need to know. First up is the principal. This one's easy. It's just the initial amount of the loan. If you buy a $1,000 bond, the principal is $1,000. Simple. Next, we've got the coupon. Think of this as the fixed interest payment that the government promises to pay you, the lender, every single year. It's always just a percentage of that original principal. Then there's maturity. Again, super straightforward. This is just the end date of the loan. It's the day when the government finally pays you back your original principal in full. And finally, we have yield. Okay, now this is where things get really interesting. The yield is the actual return you get on your investment. And it's not the same as the coupon, because, you see, the price you actually pay for a bond can change over time. So let's break that down. The coupon rate on a bond is set in stone. It never changes once the bond is issued. But after that, bonds get bought and sold every single day between investors on what's called the secondary market. And on that market, their prices go up and down. The yield is what reflects this changing market price, making it a live, dynamic measure of what your actual return is. So here is the one thing you absolutely have to remember, this inverse relationship. Just think about it for a second. If you can buy a bond for cheap, less than its face value, but you're still getting that same fixed coupon payment, your overall return, your yield, is higher, right? And on the flip side, if you pay more for that same bond, your yield is lower. Okay, so why does a market for government IOUs have such a massive, massive impact on everything else? This is where we get into the ripple effect. Any investor, big or small, has a fundamental choice to make. Do I put my money in a super safe government bond or in something riskier like stocks? Now, because everyone assumes a major government will always pay its debts, the yield on its bonds sets what's known as the risk-free rate of return. It's the baseline. Now, watch this chain reaction. If government bond yields start to go up, that guaranteed risk-free return suddenly looks a whole lot better. I mean, why would you take a huge gamble in the stock market if you can get a really solid, safe return from a government bond?
It makes stocks look less attractive, and you'll see investors start selling stocks to buy those safer bonds instead.
And this exact same logic applies within the bond market too. A bond from a company is always going to be riskier than one from a government, right? Because companies can go bankrupt. So to take on that extra risk, investors demand a higher yield. The gap between the yield on a safe government bond and a riskier corporate bond is what we call the high yield spread.
Honestly, the best way to think about this spread is as the market's fear gauge. When investors get nervous about the economy, they demand an even higher premium for the risk of lending to companies. So when you see that spread getting wider, it's often a big flashing signal that trouble could be on the horizon.
All right, so let's tie this all together. Why is the bond market truly the bedrock of our financial world? Why does this all matter so much? Well, as government debt just keeps getting bigger, so do the interest payments on that debt. For the US, that's already around $3 billion a day. That's money that can't be spent on other things like healthcare or fixing roads. And at the exact same time as those bond yields rise to attract new lenders, interest rates for everybody on mortgages, on car loans, on business loans, they all rise too. And that puts the brakes on the entire economy. Which leaves us with a fundamental and frankly kind of a scary question. This whole system, this whole thing, relies on investors being willing to keep lending money to governments. But as that debt continues to pile up higher and higher and higher, who is going to keep buying the bonds? Because if the big buyers out there, other countries, central banks, start to think the debt is just too risky, the whole system could face a very, very serious day of reckoning.